What if I told you that the biggest danger to the US economy is no longer a recession, but something even more complicated? Every major headline is sending a different message. One report says consumers are still spending. Another says hiring is slowing down. Mortgage rates have climbed to their highest level in nearly a year. Inflation refuses to return to the Federal Reserve's target. And now President Donald Trump is once again making affordability the center of his economic message. So what is really happening inside the world's largest economy? Stay with me until the end because the answer could completely change how you look at the US dollar, stock market, gold, silver, and the global economy. Hello everyone, this is Alex James, and you're watching Macro Bullion, where we break down the world's biggest economic stories through independent analysis. Remember, nothing in this video is financial advice. Always do your own research before making any investment decision. Let's begin with the biggest picture first. The US economy is still expanding in 2026. That is an important fact because many economists predicted a recession over the last 2 years, yet the economy has continued to avoid one. However, this growth is no longer as strong as it was before. Recent economic reports show that second quarter GDP growth slowed compared with earlier periods. One of the main reasons is that imports have remained unusually high, reducing net economic output, while changes in business inventories have also weighed on growth. On paper, GDP looks softer than many expected, but the story becomes much more interesting once we look beneath the surface. Consumer spending continues to surprise economists. American households are still buying goods, traveling, eating out, and paying for services despite higher prices across almost every category. This spending has prevented the economy from falling into recession. However, there is another side to this story that many headlines do not mention. Many families are relying more heavily on savings accumulated during previous years, while others are increasingly depending on credit to maintain their lifestyle. That means consumer demand remains healthy today, but questions remain about whether it can stay this strong over the coming months if inflation remains elevated. Another major engine supporting the economy is corporate investment, especially in artificial intelligence. Companies across technology, manufacturing, healthcare, finance, and infrastructure continue investing billions of dollars into AI systems, advanced computing equipment, cloud infrastructure, and semiconductor technology. These investments have become one of the strongest contributors to overall economic activity in 2026. In many ways, AI spending is replacing some of the traditional drivers of economic growth that have weakened over the past year. But while businesses continue investing aggressively, ordinary Americans are facing a very different reality. Inflation has cooled significantly compared with its highest levels in previous years, yet prices remain well above the Federal Reserve's long-term 2% target. Grocery bills remain expensive, insurance costs continue rising, housing affordability remains under pressure, medical expenses have increased, daily living costs continue squeezing millions of households. This explains why affordability has once again become a major political issue during President Trump's public appearances, including his recent economic speech in Las Vegas, where he focused on the financial challenges facing everyday Americans. The labor market continues sending mixed signals. Officially, unemployment remains relatively low at around 4.2%, showing that the economy is still creating enough jobs to avoid serious weakness. However, hiring momentum is clearly slowing. The latest private sector employment report from ADP came in below expectations, suggesting businesses are becoming more cautious when adding new workers. At the same time, job openings have declined to roughly 7.4 million, although that number still reflects a labor market that remains healthier than historical averages. In other words, companies are not rushing to lay off workers, but they are also no longer hiring as aggressively as they were during the post-pandemic recovery. This creates an unusual economic environment. Growth is slowing, inflation remains stubborn, hiring is cooling, but unemployment is still relatively low. That combination is exactly why investors, policymakers, and central bankers are becoming increasingly cautious. And in the next part, we'll look at why rising mortgage rates, Federal Reserve policy, tariffs, and global trade tensions could determine whether America experiences a soft landing or begins moving toward stagflation. Remember, these are verified macroeconomic indicators from recent economic reports, while the analysis reflects an independent interpretation of those data. As always, do your own research before making financial decisions. The next piece of this economic puzzle takes us directly to the Federal Reserve, because almost every major financial market today is being influenced by one simple question: when will interest rates finally come down? Investors have been waiting for rate cuts for months, businesses are hoping borrowing costs will ease, and millions of American families simply want lower mortgage payments. But the latest economic data continues to complicate that decision. While inflation has cooled from the extreme levels seen over the past few years, it is still running above the Fed's long-term target of 2%. That means policymakers cannot declare victory yet, and every new inflation report carries enormous weight for financial markets. One of the clearest signs of higher interest rates can be seen in the housing market. According to the latest mortgage data, the average 30-year fixed mortgage rate has climbed to approximately 6.81%, the highest level in about 1 year. For someone buying a home, that difference is massive. A higher mortgage rate means significantly larger monthly payments, making home ownership increasingly difficult for first-time buyers. Even existing homeowners are reluctant to move because doing so would require replacing older, cheaper mortgages with today's much more expensive financing. This has slowed housing activity across many regions of the United States and continues to put pressure on affordability. Housing has always been one of the most interest rate sensitive sectors of the economy. When borrowing costs rise, demand typically falls. Home sales slow, construction activity weakens, and related industries from furniture to home improvement often feel the impact as well. Yet despite these challenges, the housing market has not experienced the type of collapse that many analysts predicted. Limited housing supply and continued demand have helped support prices in many areas, creating a market that is expensive rather than deeply distressed. Meanwhile, another important economic report paints a very different picture of the U.S. economy. The American services sector, which includes restaurants, healthcare, transportation, finance, hospitality, technology services, and professional businesses, continues to show resilience. Recent business surveys indicate that service sector activity remained relatively strong during July. Since services represent roughly 70% of U.S. economic activity, this strength is one of the biggest reasons the economy continues expanding instead of falling into recession. However, there is an important warning hidden inside those same reports. Businesses are reporting that their input costs continue rising. In simple terms, companies are paying more for labor, transportation, insurance, raw materials, and operational expenses. When business costs increase, companies usually respond in one of two ways. They either absorb the higher costs, reducing profit margins, or they pass those costs directly to consumers through higher prices. This is one reason inflation has proven so difficult to eliminate completely. Trade policy is adding another layer of uncertainty. New tariffs and changing global trade rules continue affecting supply chains and business planning. Higher import costs can increase prices for manufacturers and retailers, eventually filtering through to consumers. At the same time, trade disputes create uncertainty for companies deciding where to invest and expand. While tariffs are often designed to protect domestic industries, they can also contribute to inflationary pressures if imported goods become more expensive. This combination creates what economists sometimes call a high-friction economy, such as growth continues, but every major engine faces resistance. Consumers continue spending but feel financially stretched. Businesses continue investing but face higher operating costs. Employers continue hiring but at a slower pace. Inflation continues easing but remains above target. The Federal Reserve wants price stability without causing a recession, but achieving that balance has become increasingly difficult. Now let's talk about financial markets. Investors are reacting to every economic report because each new number changes expectations about future interest rates. A stronger than expected jobs report may reduce hopes for immediate rate cuts. A weaker GDP report may increase expectations that the Fed will eventually have to support the economy. Strong inflation data pushes yields higher, while weaker inflation data usually boosts stocks and precious metals. This explains why markets have experienced sharp swings after almost every major economic release throughout 2026. From an independent macro perspective, the United States is not showing classic recession conditions today. Consumer spending remains positive, unemployment is relatively low, and business investment, especially in artificial intelligence, continues supporting growth. At the same time, the economy is clearly losing momentum compared with previous years. The challenge now is not whether growth exists, but whether it can continue without inflation remaining persistently high. That brings us to the biggest question of all. If growth slows further while inflation refuses to return to the Fed's target, could the United States be entering the early stages of a stagflation-like environment? In the next part, we'll examine exactly what stagflation means, why investors in gold and silver are paying close attention, and whether the current economic conditions are beginning to resemble one of the most challenging environments in modern financial history. Remember, the economic figures discussed are based on the latest available public reports, while the analysis reflects an independent interpretation. Always do your own research before making any investment decisions. This brings us to one of the most important economic terms investors are hearing again in 2026, stagflation. It is a word that immediately captures attention because it combines two problems that normally do not happen together. On one side, the economy grows slowly or even stalls. On the other, inflation remains stubbornly high. Under normal conditions, a slowing economy usually reduces inflation because demand weakens. But during stagflation, prices keep rising even as economic growth loses momentum. That is exactly why central banks fear it so much. Now, before we jump to conclusions, it is important to separate facts from speculation. Based on the latest available economic data, the United States is not officially in stagflation. GDP is still expanding, unemployment remains relatively low at around 4.2%, consumer spending continues to support economic activity, and businesses are investing heavily, especially in artificial intelligence infrastructure. Those are not the characteristics of a traditional economic crisis. However, several warning signs deserve close attention. The first warning sign is slowing economic growth. Recent GDP reports show that growth has decelerated compared with earlier periods. Imports have weighed on overall output, inventory adjustments have reduced headline GDP numbers, and businesses are becoming more cautious. None of these factors alone signals a recession, but together they suggest that economic momentum is gradually weakening. The second warning sign is inflation. Although inflation has fallen significantly from its previous peaks, it remains above the Federal Reserve's 2% objective. Prices for housing, insurance, healthcare, transportation, and many essential services continue to place pressure on household budgets. Millions of Americans still feel that their paychecks are not stretching as far as they did just a few years ago. This explains why affordability remains one of the biggest political and economic issues in the country. The third warning sign comes from the labor market. While unemployment remains relatively healthy, hiring is clearly slowing. The latest ADP private sector employment report missed expectations, and job openings have declined from previous highs. Businesses are still hiring, but with greater caution. That usually reflects uncertainty about future demand rather than confidence in rapid expansion. So, what does all of this mean for investors? Historically, periods of economic uncertainty have increased interest in safe haven assets. Gold has often benefited when investors lose confidence in economic stability or expect central banks to eventually loosen monetary policy. Silver, however, behaves differently. Silver is both a precious metal and an industrial metal. That means it depends not only on investor demand, but also on manufacturing activity, electronics production, renewable energy projects, and industrial expansion. If the economy slows but remains stable, silver could continue receiving support from industrial demand, especially from sectors connected to clean energy, electric vehicles, and advanced technology. If economic weakness becomes much more severe, industrial demand could soften, creating short-term pressure on silver prices even if investment demand increases. Gold, on the other hand, usually responds more directly to interest rate expectations, inflation concerns, currency movements, and geopolitical uncertainty. If investors begin believing that the Federal Reserve will eventually cut interest rates because growth is weakening, that could become supportive for gold prices. Lower interest rates generally reduce the opportunity cost of holding non-yielding assets like gold. Another factor that cannot be ignored is the US dollar. Higher interest rates have supported the dollar over the past several years, but if markets become convinced that the Fed is preparing for a policy shift, the dollar could begin losing some strength. A weaker dollar often makes commodities, including gold and silver, more attractive to international buyers because they become less expensive in foreign currencies. Artificial intelligence is also changing the economic landscape in ways we have never seen before. Massive corporate spending on AI data centers, semiconductor manufacturing, cloud computing, and automation continues injecting billions of dollars into the economy. This investment boom is helping offset weakness in more traditional sectors such as housing and manufacturing. In many ways, AI has become one of the biggest reasons why the US economy has avoided recession despite higher interest rates. From my independent macro analysis, the United States currently appears to be moving through a late-cycle economic expansion rather than an immediate recession. Growth is slower, inflation remains elevated, and policy uncertainty is increasing. These conditions require investors to stay disciplined instead of reacting emotionally to every headline. Markets often move ahead of the economy, meaning expectations can change much faster than the underlying data. The next few months will likely be critical. Every inflation report, every employment release, every Federal Reserve statement, and every GDP update will influence expectations for interest rates and market direction. In Part 4, we'll examine how global events, including tariffs, geopolitical tensions, trade disruptions, and international capital flows, could reshape the outlook for the U.S. economy, financial markets, and precious metals. As always, the economic data discussed here comes from recent publicly available reports, while the analysis represents an independent interpretation. Nothing in this discussion is financial advice, so always do your own research before making investment decisions. As we move beyond the domestic economy, we have to recognize that the United States does not operate in isolation. Every major decision made in Washington, Beijing, Brussels, or the Middle East can quickly influence inflation, interest rates, financial markets, and ultimately the price of gold and silver. That is why understanding the global picture has become just as important as following U.S. economic data. One of the biggest concerns in 2026 continues to be global trade. Over the past few years, businesses have had to adjust to changing tariff policies, supply chain disruptions, and shifting trade alliances. New tariffs may protect certain domestic industries, but they also increase costs for companies importing raw materials, machinery, and consumer goods. Those higher costs rarely disappear. They often work their way through the supply chain until they eventually reach consumers in the form of higher prices. This is one reason inflation has remained more persistent than many economists expected. At the same time, businesses are trying to diversify their supply chains instead of depending on a single country or region. Manufacturers are investing in domestic production, relocating factories, and expanding operations into countries considered more politically stable. While these changes may strengthen long-term resilience, they also require enormous capital investment and can temporarily raise production costs. In other words, the transition toward more secure supply chains is economically beneficial over the long run, but it can keep prices elevated during the adjustment period. Geopolitical uncertainty is another major factor investors cannot ignore. Ongoing tensions in the Middle East continue to create uncertainty around global energy markets. Any disruption to oil supply routes or energy exports can quickly push crude oil prices higher. Rising energy prices then feed directly into transportation, manufacturing, agriculture, and consumer goods, creating additional inflationary pressure throughout the economy. This is why financial markets closely monitor geopolitical developments even when they occur thousands of miles away from the United States. Meanwhile, central banks around the world continue to play a critical role in shaping financial conditions. Some countries are considering easier monetary policies to support slowing growth, while others remain cautious because inflation has not fully returned to target. This divergence creates volatility in global currency markets. Investors constantly compare interest rate expectations between major economies, and those differences influence the movement of the US dollar. A stronger dollar generally creates headwinds for commodities because most global commodities are priced in US dollars. When the dollar appreciates, gold and silver become more expensive for international buyers. Conversely, if the dollar begins weakening due to changing interest rate expectations or slowing U.S. growth, precious metals often receive additional support. This relationship is not perfect every day, but over longer periods it remains one of the most important drivers for bullion markets. Now let's talk about investor psychology, because markets are driven not only by economic data, but also by expectations. During periods of uncertainty, institutional investors typically seek diversification. Some increase allocations to government bonds if they expect slower growth. Others rotate into defensive sectors such as healthcare and consumer staples. Many also increase exposure to precious metals as portfolio insurance against inflation, geopolitical risk, or financial instability. For silver investors, the outlook remains especially interesting. Unlike gold, silver benefits from both investment demand and industrial consumption. Continued expansion in artificial intelligence infrastructure, semiconductor manufacturing, renewable energy, electric vehicles, and advanced electronics supports long-term industrial demand. However, if global manufacturing slows significantly, industrial consumption could temporarily weaken, making silver more volatile than gold. This dual nature explains why silver often experiences larger price swings during periods of economic uncertainty. Gold continues to maintain its reputation as a monetary asset and a store of value. Central banks around the world have steadily increased their gold reserves in recent years as part of reserve diversification strategies. While short-term price movements are influenced by interest rates and the US dollar, long-term institutional demand continues to provide an important layer of support for the gold market. From my independent macro perspective, the current environment is not defined by a single crisis, but by multiple overlapping challenges. Slower economic growth, persistent inflation, elevated borrowing costs, geopolitical uncertainty, trade adjustments, and rapid technological transformation are all occurring simultaneously. None of these factors alone guarantees a recession, but together they create a much more complex investment landscape than we have seen in previous expansion cycles. That is why the coming months may become one of the most important periods for investors in stocks, bonds, gold, and silver. Markets will continue reacting to every inflation report, employment release, Federal Reserve statement, and geopolitical development. In the final part of this analysis, we'll bring everything together with my macro outlook for the remainder of 2026, discuss the most likely economic scenarios, explain what investors should watch next, and explore what these developments could mean for gold, silver, the US dollar, and the broader global economy. As always, the facts discussed are based on the latest publicly available economic reports, while the analysis reflects an independent interpretation. Nothing in this video should be considered financial advice. Always do your own research before making investment decisions. As we bring this entire analysis together, one message becomes very clear. The U.S. economy in 2026 is neither collapsing nor booming. Instead, it is navigating one of the most complex economic environments in recent history. Growth continues, but at a slower pace. Inflation has cooled from its peak, yet it remains above the Federal Reserve's 2% target. The unemployment rate is holding near 4.2%, showing that the labor market is still relatively healthy, but hiring has clearly lost momentum. Mortgage rates have climbed to around 6.81%, making housing less affordable, while consumers continue spending despite facing higher living costs. At the same time, businesses are pouring billions of dollars into artificial intelligence, helping to keep investment and innovation alive. When you put all of these pieces together, the picture becomes much more balanced than the dramatic headlines often suggest. Some media outlets focus only on slowing growth and warn about recession. Others highlight strong consumer spending and AI investment, claiming the economy is exceptionally healthy. In reality, both sides contain part of the truth. The economy is showing resilience, but it is also facing real structural challenges that cannot be ignored. From my independent macro analysis, I believe the Federal Reserve remains in one of the most difficult positions it has faced in years. If it cuts interest rates too early while inflation remains elevated, price pressures could accelerate again. If it keeps rates high for too long, borrowing costs may eventually weaken business activity, housing, and employment more than policymakers intend. This balancing act will likely define financial markets throughout the remainder of 2026. That is why every major economic release will continue to matter. Investors should pay close attention to inflation reports, monthly employment data, retail sales, GDP updates, manufacturing surveys, consumer confidence, and Federal Reserve communications. These indicators will provide the clearest signals about where the economy is heading next. One strong report or one weak report does not establish a long-term trend, but together they build the bigger macro picture. Now let's talk about precious metals, because that is where many investors are looking for opportunities. If inflation remains stubborn while economic growth continues slowing, gold could benefit from increased demand as a traditional safe haven asset. If markets begin expecting future Federal Reserve rate cuts, lower bond yields and a potentially weaker US dollar could provide additional support for gold prices. Silver may continue following a different path. Because silver has both monetary and industrial characteristics, its performance depends on more than investor sentiment alone. Continued expansion in AI infrastructure, renewable energy, electric vehicles, advanced electronics, and industrial manufacturing could support long-term demand for silver. However, if global industrial production slows sharply, silver may experience periods of higher volatility than gold before recovering. That is why silver investors should monitor both macroeconomic conditions and industrial demand trends rather than focusing only on inflation or interest rates. Another important factor is global uncertainty. Trade tensions, geopolitical developments, energy prices, and central bank policies will continue influencing financial markets. Markets today react within seconds to new economic data or geopolitical headlines, making short-term price movements increasingly volatile. Long-term investors should avoid making decisions based solely on one day's news cycle and instead focus on broader economic trends. Looking ahead to the rest of 2026, my base case scenario is for moderate economic growth rather than a deep recession. I expect growth to remain slower than previous years, inflation to gradually ease but stay above the Fed's target for some time, and the labor market to soften without experiencing widespread job losses. Unless a major external shock occurs, such as a severe geopolitical escalation, a financial system disruption, or an unexpected collapse in consumer demand, the most likely outcome remains a slow growth, higher for longer interest rate environment rather than an immediate economic crisis. For gold and silver investors, this means patience may be just as valuable as prediction. Precious metals rarely move in a straight line. They respond to interest rates, inflation expectations, currency movements, central bank policy, and global risk sentiment. Short-term volatility should be expected, but long-term trends are usually driven by the broader macroeconomic cycle rather than a single headline. So, is the United States heading toward a recession? Based on the latest verified economic indicators available today, the answer is not yet. Is the economy slowing? Yes. Is inflation still creating pressure for households? Absolutely. Is the Federal Reserve facing one of its toughest policy challenges in years? Without question. These are the realities investors should focus on, not fear, not hype, but the data itself. As always, remember that today's discussion combines verified public economic data with independent macroeconomic analysis. Economic conditions can change quickly as new reports are released, so always stay updated and verify the latest information before making financial decisions. If you found this analysis valuable and want more independent coverage of the U.S. economy, Federal Reserve policy, gold, silver, inflation, the dollar, and global macro trends, make sure to subscribe to Macro Bullion and turn on notifications so you never miss our latest analysis. I also want to hear your opinion. Do you believe the U.S. economy is heading toward a soft landing, stagflation, or an eventual recession? Share your thoughts in the comments below because your perspective helps build better discussions for the entire community. Thank you for watching. This is Alex James, and I'll see you in the next macro analysis. Until then, stay informed, stay objective, and always DYOR, do your own research.